The term we use is institutionalizing your family, right? An endowment, for example. An endowment has a list of parameters that they have to follow from a capital deployment standpoint. They have a list of parameters from what they can invest in. Why don't families do the same thing? It's a pile of cash with a lot of people making a lot of decisions. I don't care how much money it is, a million or 100 million or a billion. If there's no process involved, it will disappear.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Isaac Richard III with us. Isaac is an entrepreneur and CEO of Mavros Capital, a fully integrated multifamily office with the mission to shape the future of how significant wealth is managed, how capital is deployed, and how legacies are extended across generations. In this episode, we talk about what are multifamily offices and how they are different from single family offices. What all services do multifamily offices offer? What all asset classes are multifamily offices interested in? What mistakes do most family offices make while managing wealth? How do more families optimize for succession and build a multi generational family office? And lots more. So, without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you from pre recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So, if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So, if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Zach, so good to have you on the VC10X podcast. How are you doing?
I'm good. How are you?
Very well, thank you. And to start things off, can we hit it off straight from the topic we're here to discuss today? What are multifamily offices and how are they different from single family offices?
Sure. Great question. So, number one, how we like to explain it. A single family office is an entity or an organization created to oversee and manage the financial needs of a specific family, which includes specifically effectively transferring that wealth across multiple generations, hopefully, right? Family offices, single family offices at least, operate, or they should operate like a company. So they have employees that can be organized as a separate entity, or they may be embedded in a family operating company, right? And so by the end of the day, it's an entity that's created to manage the affairs of that specific family. Now, where the differences between a single family office and a multi-family office structure come into play, the two biggest drivers of the single family office structure is privacy and control. So you do, in some aspect, to give up those two characteristics if you were to work with a multifamily office. A multifamily office, how we like to structure our model is we like to offer the same level of service in terms of the integrated services at scale. And so our model is driven by three areas in most family offices, but specifically us at Mavros. Um, One, the relative cost savings associated with being a multifamily office versus the costs associated with building out your own single family office. Number one. Number two, the desire to delegate and centralize the management of the wealth management needs and the interest of buying family office services versus building a single family office. So at the end of the day, the main difference of working with the multifamily office minus the privacy and control, if you will, is being able to be infiltrated in a scaled, shared service. And I think that's where clients see the most benefit um, and where we can provide the most value of just being able to share peer to peer best practices, expertise, and services on a scale level. Lastly, I wasn't going to bring this up, but obviously it's important, is the cost, right? I mean, you have to think about if not if you can afford it, but if you want to pay for that, right? When you start looking at the overhead of what it costs to effectively run a single family office, and it's expensive. We see it anywhere from 2 to 10 million bucks from a year to year basis. It's a lot of money. Hiring staff, uh, uh, HR, control, um, it can be daunting, and you have to have 2 feet in if you really want to go that route as a single family office, and not many families want to do that. Um, and you also have to decide. Uh, One of the common mistakes we see is families will have a liquidity event and they'll realize that they just don't have the infrastructure or the expertise to effectively run a single family office. So from the investment due diligence, um, uh, the process of making investment decisions, the communication between different family members, and they're just overwhelmed. And it's not a very effective process on the single family office level. So, cost aside, you just have to make sure you really want to go down that route at a single family office. And that's where the multifamily office often makes sense.
Right. Yeah, that's very interesting. So what I understood is it's sort of like there is a central operating system for which can work for uh, different family offices and cater to their needs, which kind of reduces their expenditure if they were to do it in house and hire them separately for just their own needs. So instead, they can work with a multi-family office like yours, and they can avail the services which are kind of the same for every family office that's working with you. So that way, their cost of running the family office reduces while getting most or all the benefits of running a family office, right?
Correct.
Awesome, awesome. Uh, and you run a family office yourself, a multi-family office. So Mavros Group. So what do you do there, and what are all the different kinds of operations that are there at a multi-family office? Give us an insight into that.
Sure, great question. So, on a high level, we have 10 main domains: family governance, family dynamics, investment management, next generation advisory, health, trust and estate, planning, philanthropy, risk management, transition, as you call it, and lifestyle advisory. So, private aviation, cars, travel, things of that nature. Those are the 10 core domains, if you will, that we try to focus on. um, but aside from that, uh, in layman's terms, we want to be the first call for everything personal and financial, period. And so when we say we are a strategic partner to families, entrepreneurs, executives, etc., anything you need from finding an LSAT tutor to a private jet to deploying capital in a private equity or venture, you call us. And I think that's a little bit different than the traditional wealth management landscape where I know teams and advisors, great people. I'm sure they're very great at what they do, but for the most part, they call clients 4 times a year, once a quarter. They give a portfolio update, maybe a market update. They ask about the kids, and then they don't speak for another 3 months. We talk to our clients every day. And I just think the level of communication, the frequency of communication, what we talk about, is just a little bit different than a traditional wealth management team or firm or advisor. And I think how integrated that we get in a family is also different. I mean, we're doing the accounting, the trust accounting, the partnership accounting. We have a general ledger that we facilitate to be able to look at cash flow from different entities, the reporting. So a matriarch and a patriarch, right, may want to look at the wealth differently than a 27-year-old daughter or a son, right? Don't mean to age the baby boomers, but instead of an 80-page report, maybe a family member wants to see, one pager on the cell phone right now. And to be able to facilitate those needs across a family is difficult, but one that we have to figure out. And so I just think again, the level of communication, how frequent we communicate it, and what we talk about is much different than a traditional uh, wealth management relationship.
Right, absolutely. That's very interesting. And so, as many people say, every family is different and distinct in its own self, and their needs, requirements, motivations, goals are all different, right?
Sure.
So, in a multi-family office setup, how do you cater to the different needs and desires of each and every family office that you're working with?
Sure, great question. So I do agree with you. Every family is different. And obviously, the age old term is if you've seen one uh, family office, you've seen one family office. I will say, not a caveat, but just to add, there are, however, very similar complexities and questions that most families have, right? And that's why we created our what we call an ecosystem of just community being able to ask similar questions to similar families. So, for example, there's not too many families worth 750 million bucks that doesn't know how to tell their son how rich they are. Right? I mean, that's a problem for families, and there's only so many of them out there. And to be able to ask that question to a similar family can be very helpful, right? And so every family is different, but there are shared experiences and complexities that families have. But to answer your question, great question, and how we approach it is how we approach every conversation. How can we help? What are your goals? What do you want to accomplish? And you can learn a lot about the family by just asking what do they want. And look, oftentimes maybe they don't know, right? Maybe there's a liquidity event. They spent their whole life building a tech firm or a logistics company, whatever the case may be. They may have an event and they're sitting on a pile of cash, and they realize they don't know anything about venture. They don't know anything about real estate or private equity or investing in general. They have no infrastructure internally within their family. They don't know what they want to do. Sometimes there's an event. Look at Elon. He had a huge liquidity event. He put all his money into another company. He did it again, right? And so sometimes people want to ride off into the sunset. So we just start with a conversation on what's the purpose of the wealth, how can we help, and what are you struggling with, and the answers that we get differ, obviously, but some of the complexities and challenges are similar as well. Communication within the family, family governance, um, partnerships, right, between spouses, partners, children, and taking over the family business, selling the family business. Anyways, but that's how we try to communicate those conversations within families.
Right, right. Totally. So, is that angle of community, since you have multiple clients or multiple families you're working with, they are facing similar challenges in many ways, like telling their son how much wealth they already have. That's a
Yep.
big challenge in itself, right? So do you facilitate those conversations within the community, or do you yourself try to help them through those situations? How does that work?
Great question. So we do it ourselves, but if we have a client, it's like, hey, I think you should talk to this person or this family. We'll help facilitate that conversation. I'm a golfer, so look, hey, are you free Friday? Do you want to get 18 in at a really nice golf course? I don't really get a lot of no's, so um, that's very helpful. And I don't know if you golf, but if you get 4 hours with the family and you're going through something, a lot comes out on a golf course. I'll put it that way. So, but no, again, I just think um, it's almost like your parents. Your parents can tell you something your whole life, and then you hear it from an external source, and then it clicks for some reason. Sometimes it's like that with us and clients. We can sit in a conversation, explain what we think, um, but maybe sometimes you need to hear from another family who's going through or went through the same scenario, right? Where it may click in addition to what we say. So it's a little bit of both, but obviously we facilitate that conversation, and if it makes sense, we'll help coordinate um, conversations within our own client base.
Right, absolutely. So, contrasting like single family office and multi-family offices. So, families often are facing the two options that should be build it into a single family office or join a multi-family office. Which approach should we take? So, do you think is there an AUM, assets under management threshold, that if you have over these many assets, then the cost to benefit analysis would look good for your family? Or if you have below this threshold of assets under management, then it would be more sensible for you to join a multifamily office. So tell me more about this.
That's a great question. So, rule of thumb usually is 250 million is the threshold of if you if you can even contemplate having a single family office. And the way we get to that number is simple. It's a basic math equation. Before you even look at the complexity and what you want to accomplish, it's a basic math equation. We look at 250 being the threshold. And so if you do the math of just, let's say you had 100 million, and you usually doesn't happen like this, but for sake of conversation, let's say a wealth manager charges you 1%. That's $1 million. That's $1 million. Um, Working with a wealth manager, right, or a multifamily office. Now, let's say you wanted to build out a single family office. Let's say you have to hire a CFO, CIO, a chief investment officer. Let's say the chief investment officer, he or she wants an analyst, maybe two, right? I'm going through some hiring now. They're not cheap. So 100,000, buck 50, 200, 250 if you want a good one. Um, Legal, some attorneys to draft your documents if you deploy into private alternatives. Um, an analyst for the privates, right, alongside the capital markets analyst, an accountant. And so the point I'm getting at is that's not cheap, and it gets expensive very quick off of simple overhead. And so I don't know. Um, let's say you have a team of 10 and call it 250,000 a piece. That's $2.5 million. Period. But just off of
Right.
straight overhead of salary. And
Yep.
we haven't even gotten to the complexity and things of that nature. And so the point is just do the math, right?
Yep.
And do the math of how much you would have to pay, who you would hire. Now, sometimes it doesn't have to be that big. I know single family offices with 3 people. They do okay, but they don't have the infrastructure to be able to run the due diligence of making very important financial decisions. And I think that's a recipe for disaster. And so if you're going to run a real effective single family office, it's not cheap, it's expensive, and you have to make sure you can pay for that. and usually you start at 250 million to be able for that to make sense. Now, I mentioned earlier, however, the control and complexity aspect to it, and privacy. There's families where they may have 60 entities, and it's hard for a wealth manager or a firm to be able to facilitate the trust and the entities, the accounting, effectively. It's hard too, right? And so uh, there's a lot of questions that need to be asked. There's a lot of complexity that needs to be looked at. Even aside from that, again, just privacy. How much control do you want to give up working with a wirehouse or a private bank or a multifamily office, right? Versus doing it yourself. I know families who run their operation via Excel, you know, and they don't want to change ever. Right. And that would be my answer, just from an 81 threshold, 250 million. But once you do the math, you have to look at, again, the complexity and the privacy and the control aspect if you want to keep it in house and do it yourself versus delegating that externally.
Absolutely. So, does privacy often become a big concern for family offices uh, that is a big factor in them deciding that should we be a single family office or should we work with a multifamily office, with the multifamily office being where they will have to share a lot of the information for the multifamily office to be able to manage their funds in the correct way as per their desires and needs, whereas in a single family office they would think that they would have more of the information to themselves and it would not be out there, they would not have to share it with someone else. So does that often become a big factor in deciding should it be a single family office or multi-family office?
Great question. So not often, but it definitely is a question that families ask. And I mean, look, before 10 years ago, family offices were not publicized very often. I mean, this is almost a new phenomenon within the family office landscape where people even say they have a family office, right? It was almost they want to be as private as possible. They had no website, no type of marketing literature, no LinkedIn nothing, right? And but now it's like, hey man, I want deal flow. I need help. I want peer to peer insights. Like I want to go to conferences, and so it's obviously just a whole new ecosystem publicly of single family offices that I think has changed. I think is great over the past 10, 15 years. So before, again, before a decade ago, this wasn't even a conversation. But I get why. I mean, look, just it's dangerous, man. People, will rob you, just from a privacy aspect, travel. The world is crazy. So I understand just the privacy aspect of just the world knowing how much money you have. I totally understand it. Especially now in the digital age, uh, children, teenagers posting where you are. I mean, it's you have to be very careful. Just from it's crazy saying it, but you just have to be careful. And so that's one aspect of privacy. The second aspect is what I think you were getting at is paperwork, due diligence, entities, right? I mean, just being able to provide the necessary information for a wealth manager or a wealth management firm to effectively do their job. There's a lot of transparency that has to take place. And if you've never done that for 2, 3, 4 decades, that can be a difficult transition for some families. I'll put it that way. So, I mean, look, it's a conversation that you have to have just to be transparent in what you need from an information standpoint and why. Families understand it. It's just a learning curve, I think, for them to understand what they have to delegate and provide to.
Right. Yeah, totally. And then if family office are evaluating a multi-family office uh, to decide if they are the right set of people to manage their family office, because there is a very important need of building trust here, because of the need of transparency and kind of exposing yourself and your wealth to them. So how do they evaluate multifamily offices? And I would like if you are neutral in answering that, because you run a multifamily office yourself. But what are the key things that they should look for in a multifamily office to know that, okay, these people are trustworthy and credible enough to run my asset management?
Sure. No, great question. So, I mean, look, I'll answer it just from number one for us. We're judged on two components for the most part: our client's experience and how we perform. Period. Those are one of the two most important factors of if a client is happy or not. Their experience and our execution, right? And our perform, not just investment performance, but everything. And so, uh, if I was a single family office and I had multiple providers to choose from, a private bank, the wirehouses, a multifamily office, um, I would be asking a few things. One, communication style. How often am I communicating with this advisor or this firm? Some people want to talk every day. Some people say, hey, leave me alone. Call me twice a year. I'm good. Right. So, whatever you need, that advisor and that firm has to be able to facilitate that. That's number one. Number two, um, what are you trying to accomplish? Right? Are you a serial entrepreneur and you want to start another business? You want to invest in other startups? You want to invest in venture, private equity, real estate, whatever? Um, what are you looking for from an investment standpoint from your advisor? Right? Do you want to not touch capital markets? Do you need specific deal flow? Do you want access to direct investments? Do you want access to founders and just opportunities that maybe the average investor doesn't have access to? Maybe that's an important factor. Number three, have they done this before? Are there other like-minded families that you can reach out to for help? Right, where they've gone through this scenario before with somebody else. Not only just from a due diligence standpoint, but just from a pure advice standpoint. Nobody wants to be the first family, right? That a firm is helping in this capacity. So if you have $800 million, have you ever worked with a family with $800 million? If we have 75 entities where we have to do trust and partnership accounting, and we need effective general ledger to facilitate that, have you done that before? Right? And so it seems obvious, but a family should ask that, and they should be able to have a peer-to-peer community where they can ask for help, right, and be able to facilitate those conversations. And so that's what I would be asking: communication, investment expertise, peer-to-peer community learning. I think those are really important factors. And then, at the end of the day, what is the experience like? Are they? Do you like them? I don't think even from both sides. Like I don't think you should see your advisor or client calling you and you sigh or you don't want to pick up the phone. Like it should be a natural, comfortable relationship between both parties where you want to work with each other. That also seems obvious, but people ignore that for some reason. You got to like the people. And I think that's very important, especially in an environment like this. It's high stress. It's very complex. There's a lot of moving parts, and you want to feel that you have a true partner in what can be for some people one of the most sensitive, delicate parts of their life, their finances, right? And so if you can have someone that you like to work with, they're competent, they're sharp, and they can actually help you, I think that's very important. So I think those are the most important factors when choosing a provider.
Right. Yeah, that's a great answer there. Very helpful. And so, if a family office is working with a multi-family office and they have given them a load of what are their goals, what are the kind of investments they want to make, so after that, is it the responsibility of the multi-family office to find them those deals and even make the investment decision for them based on the criteria they have set, or is it that they have to find the deals and then they have to consult the family office again that is this a good investment, would you like to make it or not? How does that work?
Great question. I'm glad you asked that. So I'll tell you a quick story. One of the prior firms I was at, I won't say which one, um, but I remember asking uh, somebody pretty high up uh, on the alternative side of the firm, hey, if we have a family or if I have a client who has a due diligence question, can I bring it to you and the team to see if it makes sense or not? And basically, the answer was no, because if we do that for one client, we have to do that for every client. And I'm like, well, that's the point. Right. And, when I got that answer, I think that was one of the first times I said, okay, I need to figure out a way to be able to do this, myself. And, one of the most important offerings that we provide is due diligence for our clients. They get deal flow, they get emails every day, and we have the infrastructure to run that due diligence. We can run the numbers, we can do the math, we can do the backgrounds, right, on the deals that our families get. And we can tell them if it's a good idea or not. We can tell them the truth. And I think that's a very powerful offering that not many firms or advisors provide. That's number one. Number two, we do get deal flow. We have a private alternatives platform across venture, private equity, credit, real estate, real assets, energy. And so we'll get opportunities. We'll send them off to the client base. Hey, does this make sense for you? We know what they're interested in on the private side just from our relationship with our clients. And so um, we have our own due diligence process that we go through on our side before we even put it in front of um, a client. But it works both ways, right? And so whether it's a fund, whether it's a direct company opportunity, a sports team, a sports league, right? And so just being able to be in that private ecosystem from both sides, running due diligence for clients, and then being able to provide opportunities for them on the other side is an aspect that we're very proud of, and one that continues to grow. So, but it's both ways.
Right. So the ultimate decision of making the investment still rests with the family, correct?
Yes, I mean for the most part we have discretion, but we don't
Hmm.
make any decisions without 100% authority from the family. So on the public
Right.
side or private side.
Right, right, right. Awesome. And talking about public private, so every client will have different needs and requirements on how they need their assets to be managed.
Mhm.
What are their liquidity needs? What are their needs for long term sustainability and stuff like that? So, how is that aspect typically managed, and what are the different asset classes you play around with for different clients while managing their assets?
Great question. So on a high level, your typical equities, public equities, fixed income, cash equivalents. Um, Obviously, the market environment changes where we allocate and how. Uh, for the most part, on average, aside from the public equities and the fixed income split, most of our clients are anywhere from 10 to 25% alternatives. That may increase for some clients in the 30% range. But to your point earlier, it has to make sense from a liquidity standpoint, from a goal standpoint, and a market environment standpoint, right? And I also think it's very important where families like to invest in what they know, right? So you'll have families who come from real estate where they made their money in real estate. They want to invest in real estate. Right? Sometimes it's you have tech founders who, hey man, I like tech. Maybe I don't want to do the Elon thing and put all my money into another company and do it myself, but I want to invest in other tech companies. Whether maybe it's a private industry, AI, or whatever the case may be, they want to be able to invest directly in the deal flow. So um, I think all in all, it's important to understand what they like, what they're passionate about, what industry and asset class they want to be involved in. But we also have clients where it's like, hey, like I want to be passive. I like my ETS, maybe a few mutual funds, maybe some individual bonds if it makes sense. But the client understanding what they're investing in and why and being comfortable is paramount. Um, and the client education across the family, I think, is also important, right? From partners, spouses, children, and everybody being on the same page and how it works cohesively with your trust and estate plan, your tax planning, not only liquidity needs, but your future investment needs, right? So if I know that you want to start a company and you may be sitting on 180 million and you may need 125 of that to really build out what you want to build out, like that's very important. And that goes into what you're invested in, right? And so again, there's a lot of factors that come into play, but we invest in everything across the public and private investment landscape.
Right. Yeah, that's very interesting. And since this podcast is called VC 10X, I have to ask this questions. Our family, how many of the family offices are interested in the venture capital asset class, and how much of an allocation are they willing to give to that?
All of them.
And even for that matter, sorry, even for that matter, investing directly into startups, because I'm seeing family offices do that as well these days, that
Sure.
they're going direct. So, yeah,
Yep.
your views on
Great
that.
question. All of them in some capacity, whether it's via funds, fund of funds, or direct into companies. But I mean, look, I think almost anybody would be interested in being able to invest in a private company while they're private, right? I mean, whether it's a seed round, Series A, Series B, I think it's interesting to be even in that conversation. Where I think it gets difficult for families is, again, do you have the infrastructure to be able to make those decisions? How are you running your due diligence? What background check software are you using? What questions are you asking the founders? Do you have a process that you use and that you follow to be able to say, yes, I'll write a check or not? Not many families have an infrastructure. So obviously we help them with that. But if they do want to do it themselves, um, to lock up capital for, excuse my French, but damn near a decade, like that's a big decision. And if you're not making those decisions effectively, again, that's the recipe for disaster. So that's what I would say to that. But to answer your first question, yes, all of our families are interested in venture. Um, I just think they have to be careful and they have to have a process in how they're doing it. Not only just venture, just private in general, private equity, buying a company, investing into a private company. Um, it's a lot to deal with, and so but yes, all of them are interested in the asset class. So
Yeah, that's very good to learn that all of them are interested in the private markets. And what do you think are the most common mistakes family offices make while managing assets?
great question. Number one, lack of communication between family members. So and it's hard, man. So you have a patriarch or a matriarch who spent the last 3 decades getting the family to the point where they can even have these conversations. And there's a lot of ego involved. There's a lot of we wouldn't even be here without me involved. There's, and I hate to say this, but I'm being transparent with you. There's children who are almost waiting for their opportunity to have access to their capital. It sounds awful, but it's the truth. And there's a lot of our family is investing this way as long as I'm alive, and I don't really care what you say. Right? And that creates a very unhealthy family dynamic. There's a lot of family conflict involved. There's a lack of trust, no pun intended. And it just creates a very difficult way to invest amongst a family. And so that's one of the biggest issues I see, just being able to communicate effectively, decision making process within family members. Um, if there's a family business involved, who takes over the family? Is it a shared equal interest amongst the children or the family members? Going through a situation now. Um, there's two children. There's um, a lack of trust with one of them, and that child is not going to be very happy, right? With understanding, his particular interests, and so um, communication is huge, or lack thereof, and we break it down into three forms of capital: human capital, intellectual capital, and financial capital. That human and intellectual capital, I think, is often overlooked, and I think it's probably two of the most important forms of capital that a family can have. If there's no education and there's no cohesion within the family, the financial capital is at risk. There's a reason why the shirt sleeves to shirt sleeves aspect unfortunately exists. Um, if you give a person with no education on making effective decisions $100 million, that's not going to last very long. Period. If you make it doesn't have to be one bad financial mistake, but if you make one bad mistake and you try to play catch up, that's where catastrophe happens. That's also recipe for disaster. And so, um, the lack of intellectual capital, the lack of cohesion on the human capital side, the financial capital is just it's a ticking time bomb. So, I would say those are the biggest mistakes: not communicating effectively, bad infrastructure, not making good decisions, family conflict, um, and it's just a bad recipe overall. So um, those would be
Right.
my best answer for you.
Yeah, yeah, many interesting things to learn there. That money seems good on the outside, but actually brings on a lot of challenges of its own. And how important human capital is in all of this, because regardless of how much capital you have accrued, it all depends on, do you also build the humans and nurture children in a way that they are going to handle that money appropriately and ideally grow it further. So that's very interesting to learn. And my last question to you, before we try to wrap this out, will be, how do families think about succession and making it into a multi generational family office?
So again, I'm going to keep harping on this, but communication and education, that's paramount. And what I mean by that is a child doesn't have to know the difference between a large cap and a small cap stock. What they do have to know is, well, they should, number one, but they do have to know the history of the family, how the family got to where they got to from a single family office standpoint, or even just a wealth creation standpoint, and just having a sheer appreciation for how hard it takes to get there. And it's okay to be an heir or an inheritant. Like, I don't think people should be ashamed of that. I don't think people should hide that. I think there's a weird stigma amongst society of things were just given to you. Um, I'm working very hard. I work 7 days a week. I'm 31 years old. Hopefully, my future children will be appreciative of how hard I work now and have worked and continue to work. I don't want them to be ashamed. I don't want them to want me to drop them off a block before schools because they don't want their kids to see what their parents drive. That's crazy. Embrace it. Your parents have done very well for themselves, and I just think there's a sense of um, embarrassment almost when families are very successful, and I think people shouldn't do that. There's nothing wrong with being a successful family. Um, But with that, I also think there also has to be a as much empathy as you can find of understanding how hard your parents worked to get to where the family is. And I think if you can come from that standpoint as a child, number one, and then from the other side, their respect from the matriarch and the patriarch to the child, where there's no ego, there's no condescending feelings of you've never worked as hard as I had to get here, so your opinion doesn't matter. It's a two-way street. And I think if the second or third generation can find that empathy and there can be a respect factor from the wealth creator, there can be much more cohesion and effective communication amongst generations. That's very hard to do, but it doesn't happen very often. And I think that's the start of a lot of family conflict, period.
Yeah,
And
totally.
that's what we've seen. And so, if you can respect, again, people who haven't done what you've done to get to where you are, if you can understand the hard work it takes to, again, get to where the family is, um, the communication and education standpoint, I think will be much more effective.
Right, totally. And I know it for a fact that most family offices do not last for more than one or two generations, right? There are very rare family offices that go on to 10 generations, 15, 20 generations. That's very rare to find. So, would you say the primary reason for that was that the subsequent generations did not value the capital or the one who created that wealth in the first place and then didn't manage it appropriately, and that resulted in the family office fizzling out? Or is it something else?
No, that's I mean that's a lot of it. I would say lack of education is a broad term, but I think when I say lack of education, um, you can't just give people a lot of money and then expect them to handle it effectively if they don't know what they're doing, right? And so it's not about just making bad investment decisions. It's the term we use is institutionalizing your family, right? An endowment, for example, an endowment has a list of parameters that they have to follow from a capital deployment standpoint. They have a list of parameters from what they can invest in. Why don't families do the same thing? It's a pile of cash with a lot of people making a lot of decisions. I don't care how much money it is, 1 million or 100 million or a billion. If there's no process involved, it will disappear. And then when you add on an '08 crisis, a tech bubble, a COVID, whatever macro environment we're in, you add in a few lawsuits from family members who weren't happy for whatever reason. You add in multiple lawsuits. You add in uh, um, some IRS bills, right? I mean, look at the Jackson family. That man has billions in royalties, and the family hasn't seen a dollar of it because the IRS said so. And there was a lack of, respectfully, there's a lack of planning involved on his side. Where it's been what 10 years, and the family's been in court, and that's just a public example. Can you imagine all the private ones that nobody hears about? And so the lack of planning, the lack of education, family members suing each other, bad investment decisions. That's where the catastrophe happens, and not being able to have wealth transfer from generation to generation. I mean, family members will literally never speak to people again, ever, over this stuff. Like, if you know what I mean, like if there's a trust in one member gets X and the other member thinks they should get X and they don't, and man, it gets messy quick. you know
Yeah,
so anyways, that's there's a lot, man. Families are so complex.
right.
And you don't have to be well off to, I mean, there's families, not well off that have family
Right.
conflicts. So can you imagine when you add a few zeros to their family balance sheet? You know, it gets ugly
Right.
quick. So, anyways, lot of issues, but I would say to make it simple: lack of education, no no process, and no infrastructure to be to make those decisions. I think lead to a lot of unfortunate causes.
Right. Absolutely. That's very interesting to learn how money makes things more complex for families and it only gets messier from there. And that makes it even more important to have a structure around it, a process and a system around it to ensure that all of these complexities do not mess with the hard work you've done to create this wealth.
Definitely.
Awesome. Now let's do the rapid fire round wherein I'll ask you six quick questions about the investing you do via the family offices that you help manage, right? So the first one goes, what are the sectors and regions you invest in?
Yeah. Global, but obviously primarily domestic here in the States. I love Europe, obviously to travel, but definitely some opportunities, across the world on that aspect. From an asset class standpoint, look, ETF, mutual funds, public equities, fixed income, individual bonds, cash equivalents, the private side, private equity, credit, venture, real estate, real assets, data centers, sports teams, sports leagues. Look, I mean, I say this nicely. I think some of those are vanity plays where you're almost investing for access and network, not necessarily for distributions and IRR, which is okay, but you have to understand that, I think, ahead of time, right? And I think you have to understand what you're investing in, when, and how. Um, and there's a article that came out the other day. The NFL is taking private equity money now. We have to think about the distributions of that, right? I mean, when do you get your money back? When somebody sells the team? Well, how often is that? You have NFL owners that are damn near 100 years old, right? And if the
Right.
secondary isn't involved, how can you realize some of that liquidity? So you just have to be careful of what you're investing in. It's okay. You just have to understand the asset class. That's all. And so, but no, we're in everything.
Right.
I think for us, it's our job to find the balance of being able to invest in multiple asset classes, but make sure they're good opportunities. But that's part of why we do have an RIA. I was at really big firms in the past. I think they're great, but they can only offer funds at certain sizes, right? They have to be able to facilitate 16,000 advisors. That's not my problem. I'm one person with my set of clients. I don't have to facilitate 16,000 people. So I don't want to have funds that can only facilitate that, you know? The hell with that.
Right.
So anyways, no rapid fire, but that's my answer.
Yeah, totally. Totally. Yeah, great insight there. But let's try to be quicker in these
Sure.
answers. These are like quick question answers, right? So, next one is, what are the typical stage of investments you make? Let's talk about the private equity side of things.
Yeah, so across the ecosystem. So we're from seed to right before IPO. So seed rounds, Series A, Series B,
Right.
maybe some private equity conversations. So we're in every stage on the private ecosystem.
Right. Do you lead rounds? Again, talking about private equity.
Um, we can,
Okay.
obviously depends on the size. So there may be a fund where they're trying to raise 250,000. That may be something that we can lead. And if there's a fund who's raising 750 million, we may be just a name on the cap table on an Excel sheet. So it depends on the
Right.
size of obviously what's raising, but we're flexible.
Totally. And what's the typical check size you put in? Again, private equity.
Sure. So we're 1 to 5 million. It's a typical size for us. Again, it depends on if it's coming from our balance sheet, from the firm. If we have to raise, there's an SPV involved. If it's coming from the clients. But to answer your question, I would say 1 to 5 million.
Awesome. Where can founders or fund managers get in touch with you in case there is a direct way?
Yeah, Isaac at mavrosgroup.com. Or my cell phone, 213-810-1718. I am a texter. I'm 31 years old. I text all the time, 7 days a week. I'm available, probably too available that I should be. But shoot me a text, shoot me an email, call me. I'm available. So
Yep.
happy to talk.
Awesome. Totally. Last one. Where can our listeners follow you?
Yeah, LinkedIn. I'm a big LinkedIn guy. So follow me on LinkedIn. I'm pretty active on there. And I'm here in Los Angeles, but I travel often. So, um, please add me on LinkedIn and we'll go from there.
Totally. I'll make sure to put all those links in the show notes below so that our listeners can get there easily. This has been an incredible episode, kind of Multifamily Office 101. Thanks so much for doing this, Isaac, with us, and I wish you happy investing.
Thank you. I appreciate it. Thanks for having me.
My pleasure.